All right, be honest. Have you ever checked your bank balance on payday, felt like a millionaire for the next couple of days, and then boom, rent or mortgage, car payments, credit card bills, utilities, groceries, and suddenly you're back to stretching every dollar and counting days to make it to the next payday? If that sounds familiar, you're not alone. In fact, you're part of a not so exclusive club. Millions of people from all walks of life live this way every single month. But the big question is this something you have to just accept, or is there a way out? This is exactly what we are going to tackle today. We are going to break down why this happens, what you can do about it, and whether this is a cycle you even want to break. Because let's be real, some people are okay just coasting alone. If that is you, no judgment, and you can choose to skip this episode. But if you're tired of the constant stress, the just barely making it feeling, and the never ending worry about surprise expenses, then this episode is for you. Let us get into it. First off, let me address the myth that only low income earners struggle with this problem. Not true at all, unfortunately. High earners live paycheck to paycheck too. It just looks different. Instead of stressing over rent and groceries, they might be stressing over mortgage payments on a $2 million home, luxury car leases, private school tuition, and credit card balances from treating themselves a little too often and too much. Over the years, I've worked with households making upwards of $300,000 each year, and these high earners still do not have enough left at the end of the month because their expenses have grown in direct proportion to their income. Maybe their expenses are increasing even faster than their income. This is what we call as lifestyle creep, and it is sneaky in nature. You make more, and so you buy the nicer car, upgrade the house frequently, have multiple vacations each year. And before you know it, your bank balance is just as tight as it was when you made half as much. So, this just isn't a problem for one group of people. It is an issue that hits just about anyone. But that doesn't mean that the solution to this problem isn't similar. If you really intend to break out of this cycle, step one is figuring out why you are in it in the first place. And there are generally two big reasons. Firstly, your income simply isn't enough to cover your basic living expenses. And or you're spending too much in areas that do not actually need to be as high as they are. To figure out which category you fall into, or maybe both of them afflict you, you need to track your numbers. And I mean brutally, painfully look yourself in the mirror level of honesty. Pull your bank and credit card statements for the last, say, 3 months and break it down. Figure out your fixed expenses. And this could be the nature of rent or mortgage, car payments, utilities, insurance, or anything that you make constantly each month, but for a given figure. Um, so how about variable expenses? Maybe it's groceries, dining out, gas, subscription, those late night Amazon impulse purchases. And how about savings or debt repayments? Are you actually saving, or does that always get postponed? Here's where it gets eye opening. Most people think they spend way less than they actually do in certain categories. You might feel like, oh, I only spend like $100 a month on this or that. But when you add up those things, maybe Starbucks or Tim Horton runs, it's actually close to maybe $300. Same with takeouts, streaming services, and other random shopping. Let us also talk about the income side of things. If your expenses are reasonable, but you still can't seem to get ahead, then the answer isn't cutting back. It's likely trying to earn more. And here is how. If you have been on your job for a while and you're doing good work, you might not be getting paid appropriately. A well prepared conversation with your boss could put in an extra $100 in your pocket each month. Be aware as to what your coworkers are making, and maybe there is a gap and you need to address that. Well, this may not be the most appropriate economic environment to have to discuss about a raise, but then at least investigate. Statistically speaking, people who change jobs every few years tend to see bigger salary increases than those who stay put forever. Corporations are okay giving a higher salary or income to new joiners while continuing to pay lower for existing employees. Whether it's freelancing, selling stuff online, tutoring, or driving for Uber, having an extra income stream can make a huge difference. But what if the option of boosting your income isn't an option at all right now? Then we need to move on to cutting expenses. I know nobody likes hearing spend less, but instead of focusing on giving up on small pleasures, let us look at some big wins, things that can make a real impact. One thing that many people may have is too big a home, and with that comes the higher expenses of maintaining and owning such a big place. So see if there is a need or scope to downsize, and that could free up a lot of things. If your monthly mortgage payment is straining your budget and forcing you into other kinds of debt, refinancing or debt consolidation to a lower rate, or maybe even extending your amortization could free up some cash flow. You can always make lump sum payments later on once your finances have got streamlined and shorten your loan term or repayment duration. If your car is eating too much of your budget, consider downsizing to something more affordable. Are you really using all those streaming services, gym memberships, and premium apps? Try setting a limit for the month and try sticking to it. Even reducing your cost by a couple of percentage points can free up some serious cash. Once you free up some cash, it's time to build a financial buffer or your emergency fund. This is what keeps you from spiraling back into credit card debt or other unsecured debts or payday loans when life happens. Aim to set aside at least $1,000 to start, or maybe even $100 to start, just to cover unexpected expenses. Once that is in place, keep adding to it. So you eventually have maybe 3 or maybe even 6 months worth of expenses saved for. Now, breaking the cycle isn't just about one time changes, it is about sticking with it for the long term. And for that, maybe you can use some visual trackers or some sort of way to motivate yourself to keep going. Set realistic goals so you don't go too extreme, because that can lead to burnout and falling back into your old habits. Maybe try having an accountability partner. This could be a close friend or maybe a spouse who you can check in with and keep you honest about your spending. So, here is my challenge to you: track your spending for the next month. Then, make one big change, whether it is you're consolidating your debt, increasing your income, or maybe cutting back on major expense. Small wins add up. And before you know it, you will be breaking the paycheck to paycheck cycle for good. All right, let's talk about inflation. Just when we thought we were making some progress, February's numbers threw us a curveball. Prices jumped again, driven by higher costs for recreation, education, clothing, and even your Friday night drink. You might wonder what was the likely culprit? Well, it's looking like the end of the GST or the HST break in February, which sent prices soaring on everything from restaurant meals to retail goods. So the big question is inflation about to take off again, or is this just a blip? And more importantly, what does this mean for the Bank of Canada's upcoming interest rate decisions? With our new Prime Minister Mark Carney's looming decision on carbon tax, the US Russia ceasefire talks impacting oil prices, and the US imposing fresh tariffs on the 2nd of April, there are a lot of moving pieces. Let's break it all down. The latest consumer price index numbers show inflation is still very much in the fight. On a month-to-month basis, CPI jumped to 1.1 percentage, with core inflation, that's excluding food and energy, hitting 2.9% year on year. Now, that is not a level that Bank of Canada is definitely going to be comfortable with. As mentioned, a big part of this was the end of the GST HST holiday on February 15th, which made everyday purchases more expensive. But here is a twist. Some factors are working in our favor. Gasoline prices grew slower than in January. Transportation and shelter costs also saw smaller gains as compared to before. The big question now is, where does inflation go from here? Now, Bank of Canada has been under tremendous pressure to cut interest rates. But the latest inflation figures complicate things. In simple terms, if inflation is still running hot, the Bank of Canada might hold off on rate cuts for longer than expected. Based on what we know today, the bank is likely to opt for a pause in the upcoming meeting in April and express their opinion to keep monitoring the direction of inflation. Economists are mixed in their estimate for the number of cuts expected in the remainder of 2025. Some are expecting one, while many others are expecting two more. So that's the big unknown because we have a few wildcards in play. The carbon tax decision, retaliatory tariffs, and global oil prices. Here's where things get a bit interesting. Well, starting 1st April, the federal carbon tax, or at least on the consumer side, was set to increase, which should have driven up the fuel cost and, by extension, the cost of nearly everything else that we use. But Mark Carney, Canada's new prime minister, I think has decided to pause or maybe even eliminate the consumer carbon tax altogether. If he does, it could help control inflation in the short term. At the same time, we are seeing the US Russia ceasefire talks that could lead to more Russian oil hitting the global market. More supply usually means lower prices, and which would ease inflationary pressures even further. But don't celebrate just yet, because on April 2nd, the US is launching new retaliatory tariffs. Now, these could push up costs on imported goods, adding fresh inflationary pressure if the Canadian government retaliates. And so we have conflicting forces at play. Lower oil prices and a potential carbon tax pause would ease inflation, while new tariffs and Canadian retaliation to those tariffs could push inflation back up. And this makes it really tricky for the Bank of Canada to decide its next move. So, what does all of this mean for you as an individual? If you are a homeowner with a variable rate mortgage, the potential pause on rate cuts means you might be stuck with higher payments little while longer. The Bank of Canada will be looking at how inflation reacts over the next few months before taking any major moves. And if you are hoping for relief in the form of lower borrowing cost, you might have to wait a little longer. So here is what I want you to do. Stay informed. Inflation isn't just some abstract economic number. It affects your daily life, your mortgage, your savings, and your financial future. We at Getting Your Shit Together will be keeping a close watch on the Bank of Canada's next moves. And I will be back soon to break it all down. Until next time, stay sharp, stay informed, and keep your finances in check.